Hello, everyone. Welcome to the 20th episode of Punch Card Investing. We've made it 20 weeks, guys. Well, almost all of us made it 20 weeks. We lost two. That should be back next week. But it's pretty crazy that we've gone. Well, we're almost at 6 months, right? Or that's pretty crazy. Like, seems like just yesterday we started this humble venture and
We've
talking
come
about
so
value
far.
investing. Yeah, so far. And today we're going back to basics, talking about intrinsic value, how to value companies, how to value stocks, valuation in general, I suppose. Kind of what we're looking at there. How do you actually go about getting to that target number that is so critical towards value investing? Just figuring out what the thing is worth. That's where the value part of value investing comes from, I suppose. But before we get into that, as always, be sure to smash that like button since it helps us out a lot. And if you haven't already, hit that subscribe button so you don't miss any future episodes in the future. If you're new to the channel, definitely welcome. We're growing every single week, which is great. We're still growing at a nice pace, and we want to keep that up. So keep smashing that subscribe button, the like button, and then hit the bell icon if you haven't already so you get notifications when we go live. Granted, it might be you might be asleep when we launch this thing since it depends on where you're from and what time zone you're in. But nevertheless, we definitely appreciate your support down there with the like button and the subscribe button, and also in the Discord if you haven't joined that already. That is also in the description. Anyways, let's get into it. How do we start to talk about intrinsic value? It's kind of, how do you ask a question about something so like fundamental?
Yeah, should we maybe talk a bit about what intrinsic value even means? Because it's very much like a value investor specific thing, right? Like,
Yeah, I guess so. Go for it. Why don't you lead us off, Tom?
yeah, I guess intrinsic value is sort of an idea that came around from Ben Graham initially back in the, what was it, the 1920s or something, when he was teaching his course at Columbia on security analysis. And it's basically this idea that the underlying value of any financial assets on, in this stream, we're going to be talking probably mainly about public companies, about stocks or businesses, but it really applies to anything financial, whether that's real estate or a bond or anything like that. It's basically the idea that the underlying value of that asset is distinctly different from its market price. So if, a sort of informed buyer and seller were to come to some sort of agreement on an intelligent price to, exchange ownership in that business for on a private sale, for example, that's kind of how we define intrinsic value. And if we can find public companies that are trading at deep discounts to intrinsic value for whatever reason, that's how value investors have kind of made a living for the past century, I think, at this point. So it's a really interesting topic. It varies a lot, kind of business to business and even investor to investor with the same business in terms of how you figure this stuff out. But that's what I'm sure we'll dive into in the episode.
And I think that's why. Well, I shouldn't. What I was going to say is that it's why technical analysis is just runs so afoul of so many of the things that we value investor type people don't like. But I would certainly make the argument that everyone inherently is a value investor because you think you're buying something for either what it's worth or less than what you think it's worth. And that's if you're a technical analysis person too, because you think based on technical analysis sort of factors based on the price, you think the price might determine the value in the future. So pretty much whenever you're buying something, you inherently have that sort of value lens, at least whether you realize it or not, and whether it's well-informed or not, totally different things. But that's kind of the basics to all sort of investing. I wouldn't dare say that, getting a good deal in groceries is value investing, but it's kind of the same sort of fundamental of like, I'm buying this thing because I think it's a good deal or at least the best deal I can get. And you wouldn't make the purchase otherwise.
Mm-hmm. Yeah, in many ways, it's quite like it's almost quite an arrogant statement to go out and buy an individual stock as a value investor.
Oh, it definitely is.
You're sort of going out and say, everyone else has got it wrong. I've got it right because I've, got some insight that no one else has, or there's something weird going on with the company pushing the price down in the short term. So I think it's really interesting to kind of get into the nitty gritty of this stuff.
There's a question that just came up from Clayton. It might be a good topic to kind of talk about. Is price to book ratio a useful metric as a screening method to find companies trading below intrinsic value? So I guess that could be applied to all multiples. And as a screening method specifically, I think that's not a way to identify a cheap stock because every company is so different. It really depends on growth and so many other factors. So something trading at 10 times book could actually be cheap, depending on the type of business, whereas something trading at 1 times book could still be expensive. It really depends on the industry, the margins, the growth, and so many other factors. So as a screening method, I don't think multiples are the best way to find a cheap company. And it doesn't really talk about any of the underlying factors. So something that I've looked into recently is Tencent, where part of the business's value comes from its stock portfolio, that is hard to actually determine its worth and isn't really factored into their market cap whatsoever. So depending on what you think that portfolio is worth will depend on the intrinsic value, I guess, that the company actually, that Tencent is trading for. And there's no metric, no multiple that's going to kind of identify that. And with each business, that's usually the case. Sometimes it's a good starting place just to look at these multiples, but it's really not going to tell you whether it's below intrinsic value or not.
You can probably say that about pretty much every metric, which is what you're kind of getting at. It's like,
Yeah.
but there's so many different companies out there at so many different stages of their lives, different industries, different risk factors, that just trying to find a magic, imagine, do I dare say magic formula?
Magic formula.
Trying to find a magic sort of one factor is it comes with some pretty significant risks, most likely. Because you might be looking at something that's pretty much irrelevant to that company because it's so different than, even if it works at 99% of companies or 99% of companies, if there's that 1% left over that you're about to invest in and you're thinking this factor is a tell-all, it might not be. So you got to look at it much more holistically, I think, if you're trying to find an accurate valuation of a company. If you're trying to be an active, arrogant investor, like you're saying, Tom, I do agree with you that it does require some sort of level of arrogance to believe that you know more than the market, essentially.
Yeah, and I think price to book is a metric that was probably more useful in the past. Like if we do go back to Ben Graham times, where businesses typically were a lot more asset heavy. Obviously, you didn't have a bunch of software businesses running around like printing cash flow with basically no assets. Those are the types of businesses where they can trade at very high multiples of price to book and still be sort of reasonably priced. But it was probably more useful back in the day when you had a lot of physical assets that could potentially be liquidated, which is sort of reflected in that price to book metric. And if you found things at a discount to price to book, there you go. It could be attractive. So, I mean, a Buffett analogy I really like, we're actually talking about this exact topic of price to book, is he described, like, let's say you were investing in 2 university students, and when you sort of invested in that student, you got a share of you got a proportion of their income that they would earn throughout their lifetime. So in this case, price to book would basically tell you all of the costs that student had to kind of get themselves to where they need to be. So, they both spent $50,000 on their education, for example. So they both have a book value of $50,000. But if one's just a complete dropkick and one is an absolute like superstar, top of the class, like, person, you're probably willing to pay a higher value, over and above potentially their book value for that,
even though the book value is
better
the
quality
same.
businesses.
Right.
Yeah, exactly.
Yeah, and in the US would probably be double that 50,000, but yeah.
There you go.
And I guess where it can, because it can be valuable, like we shouldn't just ignore these multiples, but you really need direct comparisons. You need businesses that are very similar to each other, where their business operations and margins and everything are almost identical. And then maybe you could compare price to book or price to earnings, whichever metric suits that business best. So I've been looking at a few small regional banks in America lately, just because there's one company I am interested in. And price to book is a reasonable metric for a bank. They are kind of still driven by that, or insurance is something that works as well. So I've picked out like 4 or 5 regional banks that are similar size in market cap, and I can compare price to book there and get some value out of it. It is still just a starting point, but that's where those multiples can kind of be useful.
Yeah. Yeah, I think multiples are a nice shortcut, and I forget who said it. I don't know if it was Joel Greenblatt or it might not have been him, but there's a quote that's always stuck with me around using multiples, that you sort of have to earn the right to use multiples. Like you have to understand the mechanics of why certain multiples work in certain industries and why they maybe don't make so much sense in other industries as well. So I think it's important to understand the fundamentals of valuation before you maybe leap to those kind of quick shortcuts to give you a bit of a feel for pricing.
What are some of those fundamentals? What are like the first things you're looking at? Um, I guess kind of what we've been saying is it's different for every company, but is there any like one that you're going to pretty much always start with pretty much any business?
Yeah, I would say, well, I guess the most sort of technically correct way to value a business is to look at the present value of its future cash flows. So to look at look into your crystal ball after doing some research on this company and project out how much cash you think that business is going to produce between today and, I don't know, in 50 years time, when you think it might go bankrupt or something. And then you basically have to work back and say, if I'm giving away money today to receive money in the future, I have to sort of be paid to wait. So that's what, discount rates and so on are trying to reflect. They're trying to say, a dollar earned in 10 years time is not quite as valuable to me as a dollar, received today. So that's when you see people running discounted cash flows and stuff, and they've got 10% discount rates or 8% or 15% or whatever rate, that's kind of what that's trying to reflect. I guess the trouble with things like discounted cash flows and trying to figure out the, present value of those cash flows is that you are inherently trying to predict the future. And I think it's important to understand that there's going to be a very large number of companies where you're just not going to be in a position to calculate its intrinsic value because you've got no clue what those cash flows are going to be. I think, you can plug numbers into a formula and you can speculate on that stuff. But if you're going to actually make an investment, I think you have to make sure you're sort of in your wheelhouse, I guess, in your circle of competence.
Yeah, I was about to say it depends on your circle of competency for as to what is impossible to value, because what might be impossible for you and I might be very different for, Frank over here, who might have some other thing that he knows a lot more about than we do. And that goes for pretty much anything.
Yeah, I've got no clue how to value regional banks. So
I don't either.
Frank's ahead of me on that.
I'm trying to learn, but I certainly don't have any idea yet either. It's a long process, that one.
You're getting into the flooring company game now, right?
Oh, the flooring company. Yeah, another one that I'm trying to learn how to value.
That Luckily, one's enticing. Victoria, right? That was enticing. Your initial breakdown. Whose fund was it again?
I'll credit. That's Altafox Capital. Connor Haley runs that fund. He's a younger dude and runs it mostly micro cap, small cap type stocks. So anytime he talks about a stock, it usually jumps up 5 to 10% that day, which it did. Just because he's that respected between a lot of these smaller funds and guys on FinTwit and stuff. But he put out his research, and really that's what I borrowed when I made my video. That's been the bulk of my research so far, is reading through that. So when someone like that breaks it down, it makes it a lot easier.
Yeah, for sure. Without getting into too much of a tangent there, maybe we can return to it if people want it. But when it comes to like you mentioned, Tom, you mentioned like the discounted cash flow model is like the sort of ideal, but you made it sound like there's cases where it wouldn't work. Like, can you give an example of one where like a discounted cash flow probably doesn't make sense compared to some other thing?
Yeah, sure. So a good one is a commodity business. So commodity businesses, for the most part, you have absolutely no clue. You might have a good feel for what it's going to earn this year based off current commodity prices and so on. But if you had to try and forecast out what they're going to earn for the next 5 or 10 years, not even the CEO of that company is going to be able to tell you with any degree of confidence. So that's something that's really not sort of discounted cash flow friendly, I would say. But because there's kind of a lot of uncertainty, I guess, in those cash flows. But the other thing to keep in mind is that, one of the classic lessons from Ownership Provide is that uncertainty and risk are not necessarily the same thing. So maybe you can't project out, nice, steady compounded growth for this commodity company, but perhaps, with a business like IPSCO, which you invested in the early 2000s, they've got a lot of the tubular steel in that case kind of pre-sold for the next 2 or 3 years. And the market cap at the time was equivalent to those earnings they were going to get over the next 2 or 3 years. So maybe you can't figure out what a business like IPSCO is worth or a commodity company is worth, but you can get a feel for, I guess, the valuation floor, which kind of is, I think, is a pretty interesting way to tackle some of these things as well.
It depends on the kind of investment that you're making, I guess, whether a discounted cash flow is useful. If you're looking for like an asset play, some kind of, probably Seritage might even be a decent example of that, where
Yeah,
there's
for sure.
some underlying asset that has hidden value that the market doesn't see. There's no point looking into a discounted cash flow whatsoever, because that's not where the value comes from. It comes from some hidden asset. So there's often these really small micro caps that have maybe real estate or something that has more value that's not recognized on a balance sheet. So the value that you're doing there is what is its true value of these assets, and you're hoping that one day the market will recognize that. So it has nothing to do with the future of cash flows necessarily in that type of example.
Well, it's kind of nested within, I would say, like with real estate, for example, it's commercial real estate's based on cap rates, which inherently are based on like the revenue stream that you're expecting to throw off. So you're kind of like baking in a sort of quasi discounted cash flow within the valuation of the real estate. And then when you buy the stock, you're paying attention to the real estate value. So is it just that like at some point there's always some sort of cash flow factor that is inherently important in any sort of valuation? I'm trying to think of something else, maybe sales comps or something like that with residential real estate or other types of comp businesses. I can't really think of any.
Yeah, I think there always has to be cash flow at some point. Like, if you're a long-term holder of Seritage, you're sort of expecting that at a certain point they'll be cash flow positive and get valued sort of on that basis. Like if they just indefinitely lost money all the way to bankruptcy, then the intrinsic value is zero. So you have to have some like way of seeing cash flows out into the future. And for something like Seritage, that's a whole bunch of property redevelopment, and they're hoping to release some of that real estate and get cash flows that way. For other liquidation scenarios, it might be like maybe some activist is literally getting involved in the company and winding it up. Like I was talking to Andrew Brown, who's, some of you guys might know him from YouTube. Had him on my podcast this week, and he was talking about he stumbled across some like furniture. I don't even know exactly what they do. I guess they sell furniture in stores, or I don't know if they're a wholesaler or quite what. But the market cap on that company was $10 million, like the tiniest company I've just about ever seen in my life that's publicly listed. And they had $60 million in furniture inventory. So, even though the business is losing money right now, if someone went in and just wound that thing up, that's a profitable exercise if that cash is distributed out to the shareholders. So I think it always has to end up in some sort of cash being distributed out.
Yeah, so that's pretty much just that is a net stock where it's trading below liquidation value. And I guess at the end of the day, even if you're relying on the liquidation, that's technically just a big lot of cash flow that's going to come in eventually when they liquidate. So at the end of the day, it's the future cash that always does matter. But there's different ways to think about it for different scenarios.
It's kind of like, where is the cash flow coming from? But inherently it's some sort of cash flow at some point. Yeah, that's probably the best way to look at it. For like your bread and butter business, it's cash from operations. It's cash from selling something that's not the actual assets that produce the income. It's not selling the machinery. It's selling the actual variable expenses and that sort of stuff. Whereas with like a liquidation play, it's selling just kind of everything, and you get it all in one lump sum. So yeah, I think that's a pretty good framework then. Okay, so cash flow is kind of the overarching sort of thread, or do threads overarch? It's the thread that binds everything together.
I know what you mean.
It's the thread that kind of binds valuation together. Some sort of cash flow coming somewhere. So then when you look at the cash flow, how are you discounting it? Does it depend on the company? Yeah, I'm sure it would. Do you have like a specific rule that you stick to? Like what's your discount rate, for example, for a discounted cash flow? Does it change with whichever company you're looking at? Let's just go deeper. Now that we have cash flow as our starting point, what's next?
Yeah. Well, I'm sure Frank will have thoughts on this as well, but I guess the business school kind of perspective is to use like what they'd call a weighted average cost of capital as a discount rate, which maybe you're comparing. yeah, whack. which maybe you're comparing to comparing to treasury bonds or something, because that's your sort of risk-free alternative. And
I don't know.
and
Treasuries
that's
right now are return-free risk at this point.
yeah, there you go. There you go. Oh, I've lost my train of thought now. So, okay, yeah. So, with different types of businesses, if you're using that structure, you would use different discount rates with different types of businesses based on your perceived sort of risk of those businesses. I tend to fall more into the Buffett camp, as I do with almost everything investing related, but I tend to fall more into the Buffett camp, where risk isn't necessarily like any sort of technical factor like beta, or just the underlying volatility of the stock or anything like that. It's more around how certain are the cash flows. So with a commodity business, maybe you do use a higher discount rate. I don't quite know. I know Buffett, at least, I doubt Buffett has ever fired up a spreadsheet to a DCF in his life, but I think at least mentally how he's thinking about it is that the cash coming from See's Candy spends exactly the same as the cash coming from Coca-Cola or the cash coming from Apple. And I don't really think he cares where that cash comes from. It's more about how confident is he that that cash is going to turn up. So for me, I just kind of keep it simple and use like a blanket discount, same discount rate across everything.
Yeah, so you'll kind of think of it as a rate of return rather than the
Yeah,
more academic version of a discount, but which
that's
is
a
what
good way-
I do.
That's a good way to put it. Yeah, I do.
That's
the
what
same.
I do too. It's like I use a 15% return, or discount rate is what you can call it, I guess. And that's to kind of act as a margin of safety for me as well, to achieve a definite 10% return, which is about the market average and what I'm trying to beat. So that's how I use it within a discounted cash flow analysis, at least anyway. I think, Tom, yours is pretty much identical to how I do it as well. So ours is a much more simplified approach to a discounted cash flow analysis, not the more typical academic version, but they achieve very similar results at the end of the day. And I'm sure you're pretty the same as me, where I'm not trying to be perfectly accurate. I'm just being approximately right. There's a good Buffett quote, something about that, but I don't remember it right now.
Yeah, it's you're better to be approximately right than precisely wrong.
There you go.
Something along those lines.
Because
They're not.
Go
You
ahead,
can't
Tom.
calculate these things out to 3 decimal places. They're always approximations.
Because if you're talking about a 10-year hold, like you can't even fathom like what could happen in 10 years. So it's like over stressing, like the last 3 decimal points. It's just like, what are you doing at that point? Like
Yeah.
something could change in 3 months that could totally throw this whole analysis off in a big way. So it's kind of getting that ballpark. I guess this is a good parlay into margin of safety, where that's kind of a major factor, which I guess you could say margin of safety is really just another way to say you're increasing your discount rate. How do you guys look at margin of safety in general when it comes to buying stocks?
Yeah, well, I think as much as like I said earlier, that going out and buying an individual stock is kind of like an arrogant exercise, and you're saying that everyone else is wrong. I think margin of safety protects you in a lot of ways. So the reason we're trying to be approximately right rather than precisely wrong is we're not trying to find stocks that we think are worth 100 and buy them for like 98 or 99. We're trying to buy businesses at deep discounts to their intrinsic value. So even if we come up with a relatively wide range, like maybe we think a stock is worth somewhere between 70 and 140, like that's a massively wide range. But if it's trading at 35, then, it doesn't matter if, it turns out to be worth 70 or worth 130 or whatever I said before.
Right.
If we can buy it at a deep discount to that, there's a lot of sort of underlying protection, so that if the eventual cash flows aren't what you maybe anticipated, you've kind of got in at a price where you could still get a pretty good rate of return. That's how I think about it, at least.
I think that's well said, especially with that range sort of example. It's in my head, I always just kind of think of it as like it's an increased discount rate. If I think at least the way you do it, Tom, I think the same with you, Frank, is you will do your 15% discount rate or whatever your hurdle discount rate is, based on the current cash flows or whatever valuation you're trying to use. And then after that, you see what the intrinsic value is based on that return, compare that to the price. And then once you have that sort of spread, you want to see if there's like a major margin of safety after that. Whereas if you just increase the discount or hurdle rate, you end up with a similar sort of result at the end, showing that same sort of spread. So it's different sides of the same coin. Just so people don't get confused there when we're talking about margin of safety. It's kind of like the extra to the discount rate, if you want to look at it that way.
I kind of approach it another way as well. Like I take that same margin of safety approach. But John Huber, I forget the fund he manages, but he's written a few things about this in the past, with the margin of safety coming from the quality of the business, which is just another way to ensure that your capital is safe. If you're investing in a very high quality business with a moat, competitive advantage that's sustainable for a very long time, great management and all of those things, then your margin of safety is already tied in. So you could do all your projections and discounted cash flow between two businesses and achieve a theoretically similar result. But if one business has this competitive advantage to ensure that those cash flows are going to be sustainable, then that's just another way to look at margin of safety. It's not the, I guess, academic definition of it whatsoever, what Benjamin Graham originally talked about, but just another way to think of it, particularly if you're more of a growthy investor as well. Yeah, that's just another way I look at it too.
Mm-hmm. Yeah, and I think that probably links back to the whole Buffett idea of it's more around the confidence of cash flows as opposed to trying to tweak a discount rate around here.
The feeling, how good is it? How good do you feel with the money coming in? Is it finite? That sort of thing.
Yeah. Are people still going to be chewing Wrigley's gum and drinking Coca-Cola in 30 years? That kind of thought process. Yeah.
And those businesses are not particularly common. So like when you have the opportunity to get them at a discount, that's what makes it so, that's what makes value investing hard. It's like we could identify great businesses probably all day, but so can everyone else. And they're probably trading at premiums because of that. But it's in those times of crisis or whatever, for whatever reason, there's just a random blip on the radar that causes something to happen, a black swan event. That's when a lot of the quote unquote value investors have their shot, or really just, I should say, disciplined investors. If you have enough cash and liquidity to go in a time of crisis, and you're confident in your numbers, you're confident that this business can make it through this hard time, that's where you can make your massive returns. But those events don't happen all the time. You don't get those windows to buy great businesses at huge discounts very often, at least historically speaking.
Yeah, I kind of hate to put investing into like a gambling context, but it's kind of like a pari-mutuel betting system, like you'd see at a horse racing track. Like it's not about betting on the best horse necessarily; it's about betting on the horse that has the best odds. Like if it was just about picking the best companies, investing would be very simple. But you have to find the best investments, which valuation is a large factor of that.
That's where value investing portfolios can look so strange sometimes, just like random companies you've never heard of or that are in some weird niche, boring industries, often common. But it's a good business and they got it at a great price, and now it looks fantastic in the portfolio, even though no one cares about this business itself. It's not like the more flashy brands that might be incinerating cash, but otherwise everyone likes the brands. It's kind of I think what I'm getting at is it's important to separate brand from actual business. And in some cases, a brand is very important to a business, but in a lot of cases, it really isn't. It's just about kind of how they're operating. So maybe the Coke brand is more important. The branding itself, the marketing image is a lot more important to Coke. And that goes both ways for investors and for consumers than for others. Maybe something like a Johnson & Johnson is like a darling dividend stock for many investors, but for consumers, they might not really realize how many products are actually Johnson & Johnson when they're going to the supermarket or something like that. I think that's kind of what I'm getting at there. So you see a lot of boring companies in value portfolios in many cases. Boring in quotes.
I've got 45% of my portfolio in an accounting business, so it's boring as it gets.
What a fantastic example. Are you over half? What weight do you have in KPG now?
45% last time I checked.
Under half now.
Yeah, it goes up and down. It's always around that between 40 and 50% usually.
Is that because you added your Alibaba position?
Well, I keep adding cash to the portfolio. So,
Sure.
well, cash and new positions. So I'm still at a point where I can save kind of a 10% position within a couple of months,
Mhm.
3 months probably. So the weighting will eventually decrease, assuming it doesn't keep running up in price.
Yeah.
It's not
It's
ideal
going
to
up.
have.
It's going up faster than you can earn money, friend. So
That's a good problem to have.
that
Over
percentage
the
ain't
last
coming
year,
down.
definitely true. Yeah, but ideally, I don't want to have 45% exposure to one stock, but it is my highest conviction idea at the same time, so I'm not going to trim.
Well, ideally, you'd like to have a million perfect businesses. We're talking about ideal, but obviously that's not going to happen. So it's finding those winners and riding them. That's actually hard to do in itself. This might be a good time to talk about kind of exit price. When you do your valuation work and you get your intrinsic value of the company, that might change over time. But let's say you buy the stock at a 50% discount to what you think it's actually worth. But then like 2 weeks later, nothing's fundamentally changed, but it rides up to just over that intrinsic value. Do you sell right away, or do you ride it out for a while? How do you make that sell decision if it hits that intrinsic value that you might have thought it was worth?
I personally don't want to sell based on valuation. Unless it got insanely like Tesla type valuations, then I would need to reconsider strongly. But I think a selling point should be based on a change in the fundamentals of the business, or maybe a change of understanding in the business and realizing that what you once thought isn't actually true. I don't think you should sell out of a winner. Trimming winners, I think, can be a big mistake. Or selling out of winners. Trimming's okay. If you want to even out your allocation, that's a different story. But selling out of a winner just because it's performed well could be a big mistake. For example, when I bought Kelly Partners Group, it ran up. It was about 100% return within a month or two. So it's pretty easy to jump out of it then, but it's gone up another 200% in the following 12 months. So if I had have just been like, oh, this is getting expensive or close to fair value or whatever else, I would have missed a lot of returns. And again, that comes back to your investing strategy as well. There's different ways to manage a portfolio, and maybe you want to have higher turnover in stocks and you have the time to kind of do that. But for me, I'd rather be as long-term focused as possible and be really reluctant to sell anything.
Yeah, I have a pretty similar philosophy. I must say I haven't fully sort of packed up and moved to Compound Town just yet, so I still have a couple of sort of 50 cent dollar type positions in the portfolio. So those are the types of stocks where it is kind of valuation based, and if it gets to 90 or 100 cents on the dollar, it's just kind of mechanically out. But I pretty much am in the exact same boat as Frank on the longer term kind of growing pies, I guess.
But what we're really saying is it depends on. Frankie said it too. It depends on your strategy with the company with that stock. If it's more of an asset play, then yeah, it probably makes a lot more sense. Once it hits the asset value, get out, because you're not waiting for it to compound or go to Compound Town, like you said. I love that.
Yeah, it's and it's it's the whole thing. Like, there's sort of only one reason like insiders buy a stock is because they think it's going up, but there's a whole bunch of reasons they might sell.
Yeah, that's
It's
a good point.
similar. It's similar with investors just kind of looking at their portfolio. It's like it's an opportunity cost thing. Maybe there's tax considerations, and then it's the whole what's the Pabrai saying? The mistress always looks hotter than the wife, but in fact, the wife's generally hotter. So sometimes new stocks can pop up that look really attractive, but if you're not like, the whole Buffett thing again, if you're not as confident about the cash flows from that new business because you've only been studying it for 2 weeks or something, then maybe you're best just to continue holding what you already own.
I think that's our most commonly used quote here on this channel. I think it comes up every episode.
There you go.
Because it's so true.
We should put that on the next mug. We'll have to talk to Karan about that.
Yeah, get Karan on that. I'm drinking out of his punch card brew. I just did a live stream and I showed it off to everyone as well.
Very nice.
We got our Shameless Cloners mug. We're thinking about doing another giveaway when we reach 2,000 subscribers, because I think I don't know, I didn't check the number before I hopped on, but I think we're very, very close to 2,000. So we gave away a mug at 1,000. Why not? We got to 2,000 a couple months later, so why not do another one or something like that?
We need 60 more subscribers to get there.
Oof, we are close. That's compound growth right there.
Just before we maybe jump into questions, one other thing that I think is interesting to talk about with intrinsic value, and because there's pretty wide ranging thoughts on this topic, I think, is how do you factor in debt, and sort of how do you build that into how you approach valuation? Do you guys have any initial thoughts on that?
In a discounted cash flow, for example, when you're looking at the net present value of future cash flows, once I get to that point, to actually get intrinsic value, I'm either adding or subtracting back in net debt or net cash.
Right.
Current net debt or net cash. So I'm not making any predictions on it there. It's likely to change over the 10-year time period. But I think you need to factor that in for your intrinsic value. So it's not just a future value of cash flows. It's also adding back in the current value of cash or debt, whichever that might be.
Yeah, I do the same. And also, this is different side of the same coin, but if it's this is where looking at the cash flow compared to the debt is helpful. And this gets built into a discounted cash flow anyways, if you do net debt or net cash. But look at how quickly that company could pay off that debt if it put all of its cash flow towards it. That's kind of a good way to see, like, how leveraged does this company really? If it came down to it, they needed to start paying down this debt. How long would it take? Are we talking about 30 years or are we talking about 2? So that can be a big consideration as well. Even if, like, at their current market cap, it might look like they're super highly leveraged. But if you look at their cash flow, you could be like, well, they could pay this off next year if they wanted to because they're throwing off so much cash. So, like, that's another consideration to make. How much cash could they divert towards this debt? It'll depend on whichever. It'll depend with each company, but like Frank said, you end up putting it back in the end of a discounted cash flow anyways, where you look at net debt or net cash, because that's like your year zero cash flow, basically. Is how it works.
Yeah, I think with some businesses, the debt situation is quite straightforward. Like a lot of these, really capital light compounders often don't have a lot of debt, like a Facebook or a Google or an Apple or that sort of thing. So you don't really have to worry about it. Seritage is a good example where you should definitely pay attention to it. So
any real estate company really,
yeah, for sure. Like, I mean, if you look at some of the numbers Brad did when he was kind of working through comps for each of the Seritage properties, I think he came out with something like, if you put it in, I think he just presented it in just total dollars at that time, not per share or anything. But I sort of went through the exercise and put it in per share terms. And I think Seritage, by his assessment, had like $80 per share in assets, but they had like $50 per share in debt and preferred stock, which gets you to kind of 30 net. So if you had just ignored those things, you can get to some very weird places with valuation, and things look a lot more attractive than they should. So I guess, definitely pay attention to things like enterprise value rather than market cap, I guess, is kind of what we're getting at, right?
Yeah, and the amount of interest on that debt too is very important. What kind of debt are we talking about here? Is this like a 5-year note or a 25-year note with like low interest or something? And so that's important to pay attention to too. How much interest rate are they interest rate risk are they exposed to? That's another thing to potentially discount if it's a variable rate loan or something like that. And that can get very complicated very quickly, even though it might seem like one simple number on the surface.
Yeah, and this is why a lot of value investors kind of just steer clear of companies with debt, because it can get too complicated, and it can, if things go south, it can just bankrupt businesses, and your little intrinsic value spreadsheet doesn't matter too much anymore. So, but as you get deeper into these things, like really understanding some of those debt structures can actually be quite interesting. Like, if they have potential to get lower interest debt when they, roll that over or whatever they want to do, that could be pretty interesting from a cash flow perspective for highly levered companies. And I haven't done much work on this particular stock, but I hear Bill Brewster from Value After Hours always talking about QVC. I'm not sure if you know much about this or not, Frank, but I
Not too
think
much.
QVC, yeah, I think they issued some debt that's due in like 2050 or something, and it's at a ridiculously low rate. So that's debt that you would treat very, very differently to, some like
Junk
8%
bond.
thing due next year or whatever, So
Yeah,
yeah,
for sure. Or like the Buffett bonds in Japan for 0%.
exactly.
It's
Yeah.
just
Yeah, yeah,
ridiculous.
for sure.
um, to
Before we jump into our questions, can I just add one more thing that I think about for valuation?
go
I'm
for it,
curious
Frank.
if you guys kind of do this at all, whether it's in a different way. It's called the Davis double, which is a valuation method that Shelby Davis made famous a long time ago. He was an insurance investor, pretty much exclusively invested in insurance, and has one of the best long-term returns, close to what Buffett has been doing for a very long time period until he passed away. But he made this Davis double method pretty famous, and it's probably the most simple and straightforward way to think about valuation. It's just taking three numbers, so the business growth that you expect, multiple expansion or contraction, and the dividend yield. And that is the return you'll get per year as a shareholder. So whether you want to project out over 5 or 10 years, whatever you want to do, that's up to you. But how much can the business grow? Probably thinking of free cash flow per share or earnings per share, whichever one you would like for that method. Then is the multiple going to expand from a 10 PE to a 20 PE? Because that will generate a lot of your return. And then is there a dividend yield as well? And adding those three numbers together gives you your expected return. And pretty much before I do any valuation, I kind of think about that first. If that's over 15, then it might be worth it for me. If not, then I don't really need to bother with a lot of other valuations because that's the starting place I look at. Do you guys do that at all or think about that at all?
I will make a comment on multiple expansion, because one thing I struggled to weigh, if you kind of look at like a long term, this is more of a macro lens, but like the last few decades, basically since the 1980s to now, we've had continuously lowering interest rates. How much has that affected multiple expansion just across the market in general? Has it really affected things very much? The only reason I ask is because we're at rock bottom interest rates right now. Maybe they could go negative, and that brings its own problems. But we'll just say they're at zero now. Interest rates would probably only go up in the future if they move, which would probably hurt multiples across the market. Is that something you consider now that we're just at objectively rock bottom interest rates, or do you not even are you not really concerned about it? Do you think multiple expansion is totally tied to company quality, or at least it's primarily tied to company quality? Of course, everything's tied to the general market in some way, but how do you kind of weigh that?
I don't weigh it directly. I do usually when I'm doing a Davis double, almost always I'm looking at multiple contraction rather than expansion. So
Sure.
it's taking away from the business growth. Almost every time that's the case because I'm looking 5 years out or 10 years out into the future. So typically a company is going to be much larger by then. Maybe there's more competition and margins thin, growth slows. So you're probably 10 years out, you're almost always looking at a lower multiple unless you're at a very early stage company that just happens to be trading cheap. So something like these Chinese stocks, Alibaba, you might get some multiple expansion over 3 years if the market decides they like China again. But 10 years out, the company's going to be so big and growing a lot slower that you can probably expect a lower multiple than you do right now. So
Sure.
I'm actually looking at multiple contraction most of the time in that example.
That
And
makes
even when
sense.
you do a discounted cash flow as well, you put in an exit multiple on it as well.
Yeah.
So part of your intrinsic value is that exit multiple, which almost exclusively for me as well is lower than the current multiple, which I think is an important consideration too.
And you can always lower that more to make it more conservative, add to that margin of safety or whatever you're going for, however you want to do it. So yeah, that makes sense. Tom, any thoughts there, or should we dive into some of these questions?
Yeah, what Frank said.
We had a good one on debt. Wouldn't having debt be beneficial in low interest rate environment to build a strong moat before interest rates start to rise? So basically taking debt, investing it, building up the business, and then getting out of the debt, which I guess is how a lot of companies start or grow, especially in these lower interest rate environments where things are so distorted. And you can get some very low interest rate debt, even as a quote unquote lower quality company, you can. There's a lot of money floating around. Is really what I'm trying to say, and you can get money to try and build your business in that way. I guess the one thing I'd say here is like, sure, it's beneficial in a low interest rate environment if you can beat that interest rate, but then in a high interest rate environment, everything's getting more expensive. So like, sure, you might be able to even if your returns are higher in a or what am I getting at here? I should say in a low interest rate environment, your risk-free rates like treasuries and all that stuff, if you can call that risk-free, is that gets lower too. So it's just kind of like a relativity thing. Like sure, interest rates are low everywhere, but it's also harder to get higher returns now because everything is so much cheaper. So like I'm just saying it's not necessarily that much more advantageous now than it would be in 10 years if they got the debt then. It just kind of depends on how efficiently they can allocate that debt and how quickly they can get their cash flows up to pay back that debt, to manage the debt, and also to have enough reserves in place if a crisis arises. So I wouldn't pay too much attention, I guess, to like the low versus high interest rate environment. I would pay more attention to like how much cash flow can this company really bring in to pay back that debt, because that's always going to be a risk in a high or low environment, different than kind of the multiple thing we were talking about earlier. I'm getting a little rambly. You guys have any thoughts on this one?
I think again depends on the company. I'd say if you're going out and doing what Jack's doing and buying like real estate down the street and fixing at low rates for 30 years, I think you can make a very good argument that that's an intelligent thing to do.
Yes.
I think if you're a,
I agree.
I think if you're a gold miner and you've just seen the gold price shot up and you want to borrow some money to get a new mine up and running in the next 3 years, that's an entirely different story, and you can really run into trouble there. So it's important to just put it in the context of the company, and then if you're going to get into something with a lot of leverage, you have to really understand how that debt is structured. I would say, like, what are the terms look like from an interest rate perspective? Are there any, big debt payments due in the next few years that they're going to struggle to meet? Can they generate liquidity elsewhere? Like, if you look at it on the surface, Seritage is probably a company you'd say that is going to struggle a lot to pay their debt, but they can bring in new liquidity from, selling off small pockets of real estate that they don't want to redevelop. So you have to just get into those nuances a little bit more. And I would say that a lot of like, quote, moti companies tend to either not require a lot of debt to grow, like maybe it's a Facebook that needs basically no capital to keep growing, or maybe you're a See's Candy that can't grow no matter how much capital you try push into that bad boy. You kind of just maxed out the size. So I don't know if that answers the question, but there's a few thoughts for you.
I think the business, it's really dependent on the actual business you're looking at, but raising debt is just a way to get capital to allocate for growth, essentially. And there's always better ways to do that regardless of the interest rate environment at the time. Ideally, if you have excess amount of free cash flow, you want to be reinvest those cash flows for growth rather than relying on debt. You could also raise capital depending on what kind of multiples and valuation you're trading at. Maybe it's better to sell equity just to fund your growth. It's very dependent on the business. Like that flooring company, Victoria, we talked about earlier, they're growing through acquisitions, so they need a lot of capital. So they have two different types of debt that they access. One has about a 3% interest rate, which is great. The other part is like at 8 or 9%, I think, from memory, which is definitely a lot more concerning. And then the remainder part of that acquisition is from cash. So there's just so many considerations to what the business is trying to do with that capital that they're raising. And arguably debt would be one of the worst ways to do it. Diluting shareholders isn't always ideal, but in the right scenario where it can lead to a lot of growth, that is fine too. But I'd always prefer to see the cash flows being reinvested and not having to think about debt.
Well, I think it kind of to push back a little bit there in that it's like worse most of the time. I think it very much depends on like your return on invested capital, and also the debt terms. If you're getting up into that 8 or 9% debt range, like you better be very confident that you're going to get a pretty high return there, or you got the cash flows to justify it. it's but if you can get like amazing debt terms, like 0% bonds out in Japan, to go invest that at a 10% return, well, I mean, if they're giving it to you, it's worth considering, and then you don't have to dilute shareholders, and they lose out on that sort of, that dilutes your return on invested capital in that way, I suppose. So,
which I guess is why something like Victoria that are doing that, I'm fine with. I actually like that they're using debt for that reason, because they're generating such high returns on tangible assets is probably the best way to look at it in their case, which is somewhere in the 30 to 40% range. The amount of capital that they're going to reinvest is almost going to double their EBITDA and earnings over the next 2 to 3 years, depending how long it takes to actually reinvest that capital. So as long as the returns coming from that far outweigh the interest and things like that you have to pay on the debt, that's the most important factor.
Yeah.
But I think if you're looking for the highest quality businesses like the Apples and Facebooks, Amazons of the world, they're not really relying on debt so much. They just have so much excess capital, it doesn't matter.
Right. They already have a lot of cash saved up, and they're throwing off a ton more every year. So they're just at a different level of maturity in that way. But yeah, that was a good question. Let's get into some others. Let me go back up to the top, see what we missed. Superstars. Is that us?
Heyo.
Thanks.
Kalichiwaba in the house.
Tom, you were on his channel, right?
I did a podcast
That's right.
with Kalichi, I don't know, 3 months ago, maybe something like that.
Yeah. I thought I remembered that. Good stuff. Here's a good question from him. How much do you factor sentiment into the value you place on a business? Like, so how much do you factor like quality feeling, I think is what you're getting at? Which is kind of hard to explain, I guess. It's just kind of like that feeling like this is a good business. It's predictable. It's not too complicated to understand. I think that's almost like the first sort of factor for me. It's like, can I even understand this business? And if I can understand it, then I can have a judgment on like how, quality is it? How is it a shady business? Is it, is it super vulnerable? That you have to make that consideration kind of first. At least that's how I'm understanding the question.
Yeah, I'm not sure if he's talking about maybe market sentiment towards a business or something. Which,
maybe.
In that case, like, if someone's really negative towards a business, that almost gets me more interested in it. Like, there's
Tom, you're so arrogant.
Well, it doesn't mean like it's an obvious buy. It's just like a nice place to look. Like, it's the whole, Buffett Munger basically never buy an IPO because it's so hyped up and you're very unlikely to get a deal when there's 50 investment bankers behind it, kind of trying to sell the thing. I don't know if you guys know Mike Mitchell at all, but he has probably the best Twitter handle, which basically answers this question. I think he's at Ignore Narrative on Twitter. So I like that.
So it doesn't matter to Tom, market sentiment. And that probably if we're talking about intrinsic value, sentiment doesn't. Do I dare say sentiment shouldn't factor into it? Because at the same time, that's kind of part of multiple expansion, sort of. Multiple expansion, or the multiple people pay in general, is a reflection of sentiment, of how confident people are in it for whatever reason.
I guess
it's just hard to quantify. Like, how do you?
Yeah, if you're valuing a business based on its cash flows. Oh, sorry, did I cut out there?
No, you're good.
Okay. If you're valuing a business based on its cash flows, like the sentiment of the stock over the long term will follow the cash flows. Like, if there's a short term sentiment issue, that'll be ironed out if you're right on the business. So
if you're throwing off a bunch of profit, that'll silence the critics, or
unless maybe you're
cash.
Unless maybe you're a tobacco company or something, that could be a different story. But
I guess so. Yeah, if you're trying to go for a multiple expansion in one of the sin areas, it's a lot harder.
Yeah.
Like the Chinese tech giants that we're all invested in.
Yeah, right. I'm not too exposed yet, but yeah, I've been slowly building out the Alibaba position, very slowly, as it continues to just get driven down into the ground. So slowly watering the plant. What else we got here? How do you assess the intrinsic value of a company which isn't yet profitable but soon will be? Do you guys spend a lot of time looking at unprofitable companies? I definitely don't, at least yet, because it kind of goes against that predictable tenet where you want to have like a predictable free cash flow, ideally, but obviously not every company is ideal, and you want the company to get to that point. And if it does, that's where a lot of the return can come from. Frank, I know don't you have a few companies in your portfolio that have at least recently lost money or are losing money, or at least on your watch list? And
Yeah, I'm much more willing to invest in a company that isn't yet profitable. I have a few times. But you're still looking at the projections of future cash flows. Like you're still trying to determine that, and you can still essentially discount cash flows back over time. But you really need to look at the fixed and variable costs that that company has. How is it going to change when this company scales and continues to grow? What are those expenses going to look like, and how is that going to move down the income statement and towards the cash flow statement as well? So if you're looking at a company that you're very certain about their fixed costs are going to remain fairly stable, their variable costs might go down or grow slower than the revenue growth is going, then eventually that operating leverage is going to kick in and they'll be profitable by 2-3 years out, whatever your calculations predict. There's certainly more risk in doing that, but when you're looking for a very early stage company, that's typically the case. Usually in micro caps or smaller companies in general, they are reinvesting a lot of money back into the business to try and grow early on. And then as they scale, those costs become less of an issue. And then the margins raise and you get cash flow. So you can still value and predict 5-10 years out how much cash flow will this business have produced, and value it that way. It doesn't change too much. You just have to be more right about those expenses that the business has and how they'll change as scale happens.
I think kind of along that line, Timothy asks, how do you go about predicting future cash flows for cyclical businesses as opposed to non-cyclicals? Does it change anything very much? And by cyclical, I assume he means more like broader market cycles, like maybe on like the commodity side, as opposed to like seasonal, more short-term stuff. I think more long-term cycles, I'd imagine.
Yeah, I think it depends on the business again, which is
of
a
course.
little bit of a cop out
That's the
answer
caveat to
we've been using
everything.
a bit. But I mean, I think commodity businesses I basically pass on almost every time unless it's a IPSCO or GraphTech situation where they've got locked in contracts for the next few years and it's equivalent to the market cap. So in other words, the valuation of that business is below the floor of what you think it's worth. Figuring out what it's actually worth is much trickier. But I mean, there's also I'm also invested in a business called Thor Industries, which sells like RVs. And you could argue that is quite a cyclical business. So in that case, you sort of you just have to look at the long-term growth and almost accept that cash flows are probably going to be a little lumpier than, a Facebook or a Google or something. But
I guess cyclical
you can look at the track record.
Like cyclical is another way to just say volatile, like not necessarily more risky. It's just like, the highs are going to be higher, the lows are going to be lower, but like it should even out if it does what you think it'll do. Like you're looking at the average. That's really all a discounted cash flow is. You're looking at the average over a long time. It's highly unlikely that it's just going to be like a slightly straight line up the whole time at like a consistent growth rate, which is probably how you're doing it. Maybe you change that growth rate a little bit, but the growth rate could change pretty wildly year to year, especially for a younger company. So it's kind of how and that could happen to the cyclical company as easily as a non-cyclical. You have a bad year or a great year and it should even out over the long term.
Yeah, I think you do have to be careful with them sometimes. I think I don't really like the term value trap because I think if you get caught in one of those things, you probably just were wrong rather than getting caught in a value trap. But with some of these cyclical businesses, they can obviously have big sort of boom and bust type earnings. So they can look really cheap when earnings are great and maybe they're not necessarily. So I mean, pretty much every business is cyclical to some extent. It's just, there's businesses that are very steady over time, through almost any cycle. And there's some businesses that swing wildly. And for each individual investor, there's probably going to be some threshold on that spectrum where you just have to start putting things in the too hard basket.
Probably the least cyclical would be the most tied to like government contracts or something like that. And then the further away you get the more you get towards the like a freer market is probably where you see more cycles, I'd bet, or something like that.
Funeral homes, most stable business in the world.
Yeah, that might be a good exception for the freer market side.
And you can also run like worst case scenarios if you're looking at something that, say, relies on a commodity price of some sort.
Yeah, true.
When you're predicting those cash flows, run worst case scenario. If it's the barrel of oil that you're relying on, run the lowest number of the 10-year, 20-year average, whatever you want to do, and just be conservative as possible. Usually, in my mind, I'd avoid highly cyclical businesses. There's something like a Nintendo I'm looking at that historically has been cyclical, not to the extent of a commodity business, but the video game industry and consoles in particular are cyclical. But that thesis kind of relies on that cyclicality kind of smoothing out over time as they add more recurring revenues back into the business. So for that, maybe you can use a conservative kind of prediction of cash flows and assume that it's going to kind of stable out over time. But like Tom said, and we'll probably say it 100 times over these streams, it depends on the business. But yeah.
And that worst case scenario sort of example that framework, I think is super important. That's what I did with this kind of goes back to the interest rate sort of thing. Like with real estate in the US especially, it's so tied to interest rates because like everyone buys houses and real estate in general with debt. And if the debt interest rate goes up, the property price will go down. Even though your payment might be about the same, but that's typically how it goes. It's just because the cost of money goes up. So because I'm planning on holding for the long term anyways, I just say, all right, 30 years from now, let's say interest rates are like 8% higher than they are now, and the property value is cut in half. Would I still be okay based on my initial investment? What would my return look like? And if it looks decent, then like, all right, I don't really have to worry about interest rate risk then, because as long as I hold for the long term and it brings in enough cash flow, then you're good. And you could do something similar with your stock investment. If it still looks like palatable, not great, because it's not going to be great in a worst case scenario, most likely. But if it is great, then you probably found a great investment. But if it's at least palatable in the worst case, then it probably means it's really, really good in a normal case or like an expected case. It's important to kind of weigh that worst, normal, and then best case scenario all together when you're doing this sort of thing. That's with a cyclical or a non-cyclical.
If you found something where in the worst case scenario you're not going to lose money, you've probably found something pretty interesting, I would say.
Yeah, exactly. Or you're just wrong.
Or you're wrong.
You're doing something wrong. Too good to be true. Trying to find another question here. That's for you, Tom.
Thank you. Yeah, that one was fun. Andrew has some wild stories. Like he was, I don't know if you guys listen to the podcast or not, but he was like, when COVID first started happening, he was like stuck in the mountains with only him and one other person for 3 months, and then made like a 3-day trip across the Black Sea to get to Ukraine for a bit of freedom. It was like insane.
I only started it. I need to finish it though.
That furniture company I was talking about before, which had like 60 million in inventory and a market cap of 10 million, that story's in that episode as well.
There's a real recent question about that actually from only a couple of minutes ago, Jack, if you want to try to pull it up.
Mm-hmm.
It says, in a net situation, if you're looking at inventory as a large part of the assets, a la Tom's recent interview, how much value can you place on that inventory valuation? And that's actually a really good point. I wouldn't rely on that completely, because the longer it's furniture, is that right, that we're looking at? So over time, that furniture is not going to be worth as much as it is at the current value. So you would have to discount that at whatever you see as applicable, but it depends on the type of inventory that it is. If it's seafood, you don't want to include it at all. If it's furniture, you can kind of include it. If it's something that's not going to change value over time, then you can count it at 100%.
Well, you got to think of storage costs too. Furniture's big, so it's going to take
True.
up space, and that's rent or whatever. So that's something. Yeah, but that's a good point about like perishable versus non-perishable inventory. Yeah, seafood inventory is not going to last you very long.
If the seafood's still swimming around, you'll be fine. But if it's already,
even then
processed, yeah.
And the thing you can do, sorry, Tom, instead of looking at net current asset value, which is a typical net, you look at net working capital, which kind of, depending on the asset, you kind of trim it off. So cash is worth 100%, but then inventory is worth only 50%. Yeah. And accounts receivable is worth 75%, because you can't rely on those types of current assets as much as some kind of bond or cash that is completely has its value and will stay that way over time.
Yeah, that's a good way to look at it too. And there's always a chance that the inventory numbers are kind of inflated. Like if they had to do a fire sale of all their inventory, are they really getting it at the price that they're saying it's worth, or is it going to be discounted a bit anyways? Like even with like a furniture blowout sale or something like that to get rid of everything. Like sure, they say it's worth this, but is it really if they were going to be liquidating? Just another way to discount it potentially.
Yeah, well, I can tell you what Andrew did. I'll just give you the highlights. If people want the full story, they can go check out. That's my shameless plug for the podcast.
Like if it's extreme, or if it's at like the actual cost basis, not the actual like sale price, then yeah. But go on.
So Andrew was his goal was to literally buy up 3% of the stock in the company so he could do proxy votes and all sorts of things. Like he was willing to kind of go activist on this thing, and he was gonna. So the company I think is based out of Las Vegas, and his plan was to fly from where he's based in Ukraine to Las Vegas, pay a furniture liquidator a couple of grand, and literally go into the warehouses and value the furniture in a fire sale. So that was his due diligence. So if you're willing to go to that sort of level, that's one way to do it. Unfortunately, in this situation, he actually found out that he initially thought all of the furniture, I think, was in one warehouse. I'm pretty sure it was in Las Vegas. Might have been LA, somewhere in the States. But it turns out it was actually scattered through like China and Malaysia. Wow. So at that point, and it was some like tiny little footnote in an annual report that just happened to mention that. So at the time, I think he'd had a double on the stock and kind of just got out. But I mean, we were talking about like, if we were imagining like Warren Buffett starting out with 10 grand or something today, like what kind of stuff would he be doing? This is it. Like if you're willing to do the work, you can find some pretty interesting stuff.
That's like extreme cigar butt sort of feel to it. Even bringing an appraiser out, that's hilarious.
Yeah.
Hard to do that with a $2 billion company. 10 million? Yeah, okay. We can get going.
Harder with Apple or Amazon.
Yeah.
You can't just unless you're Buffett, you're probably not buying 3% of the stock or something.
Yeah, right. Let's get a couple more questions we can wrap up. Let's see. I'm trying to be selective here. We got some good ones. Here's a good one from Shane here. What are the telltale signs of a management team that knows how to allocate capital? What can we look for in terms of ratios or things of the nature like high ROIC? Or I guess, are there things other than our ROIC to look at to know like you got some good capital allocators here? Frank, this seems like a great one for you, given that it's kind of with KPG and now this Victoria is it partners? No, Victoria, whatever. These like high ROIC businesses, like what do you look for there, or what are there other factors to look at?
So returns on invested capital, returns on equity, depending on the business. Like Victoria, I'm looking at returns on tangible assets, They are the key numbers that stand out to know if management's allocating capital well. You could also look at things if they're buying back shares. When are they buying back shares? What kind of prices are they paying? If you're looking at acquisitions, what are they paying for these acquisitions? How are they raising capital to do that? Are they funding it through debt or cash flows? Things like, are they paying a dividend when they shouldn't be? Did they stop paying a dividend, like in the case of Victoria, when the new chairman, blanking on his name, stepped in 6 years ago or so? He cut the dividend straight away and started reinvest that capital towards acquisitions, which is, instead of getting a 3% dividend yield, you're getting 10 to 15, 20% extra returns from an acquisition. So it's those type of decisions that they're making. But yeah, are they diluting at the wrong time? Like, are they trading cheap and they're raising equity that way? Yeah, just all those different capital allocation decisions they make. But in terms of numbers, the return metrics are probably the quick and easy place to look.
Yeah, pretty much what Frank said. Again, the only thing I would add to that is you can look at how they manage debt. I guess is the other thing. That's a capital allocation decision also. So if they are using debt, are they doing it intelligently and they're not this levered gold miner I was talking about earlier, or they're not like I think Starbucks have been doing like levered buybacks for a while, which spreadsheet junkies might be able to justify, but I'm not a huge fan of that.
Or just board members with share-based compensation plans, or share-based metrics. Or how about one more question? What's a good one? You guys see one you want to answer? I found After Dinner Investor, the undisputed king of the chat. He's got a few questions in here. Should we pick one?
He's in the house. Yeah, here's one about where's Brad. Yes, Brad is in Turkey. He's kicking the tires on racist logistics.
Yeah, he's in now. He's in. He had submitted his order with Fidelity. I wonder if it went through. Did we hear that?
Don't know. We should try to get him to go live from one of the warehouses or something.
Yeah, he's definitely in there right now with his GoPro.
Yeah.
The leak is not plugged. It's not like an active leak. It's that water was coming out of my main sewer line, and during the storm that we had, all of the sump pump water came into one little spot. So it wasn't really like a leak on the inside. It was on the outside, and it pooled up and then came over through the window in the basement, which was not good. But that is being completely fixed on Wednesday. So as long as we don't have another torrential downpour, I'll be good. And then my basement leak will be solved. And then we got to put everything back together, which is the no fun part.
There's a recent question, Jack, about the Alibaba donation from Carl. Did you talk about the Alibaba donation, which I'm sure most people here follow our channels and we talk a lot about Baba. So I can touch on that one if you want.
Do it.
Tell us how it changes free cash flows.
Yeah, so I actually just put out a tweet this morning. So this one's, I'm reading from the tweet now to make it easy for myself.
Go follow Frank on Twitter, by the way. Good stuff.
At Frank Investing. So they announced $100 billion. It's $15.5 billion in US dollars to make it easier for us, which is almost exactly the same amount as Tencent's donation as well. But they put a time frame on it. So it's a 4 to 5 year, or 2025. They will have whatever you want to call it. Donation is what most of the media throw out. But
I love donation.
Their wording has been an investment. So there's a chance that this does offer a return to Alibaba. And the one thing I talked about, worst case scenario, you get positive brand recognition for contributing to this. Otherwise, you get future customers that are moving out of poverty and eventually enter the Alibaba ecosystem. Just scrolling through.
Vague, but okay. we'll roll with it.
Well, part of what Alibaba's value is these people having more disposable income to spend
True.
in China. And that's how a lot of their growth is going to come in the future.
That just tells you how big they are, that they can influence like macro level growth to get new customers potentially. That's crazy.
So the actual dollar amount, so the 15 billion, that is 30% of their cash on their balance sheet right now, or 50% of their net cash at the moment. If you assume that grows at half the rate that it has in the past, then it's 25% of their net cash position in 2025, which is pretty insignificant because they have such a huge net cash position. Even if they were in a slight net debt position, that wouldn't be the worst thing for Alibaba. So it's not concerning in that sense. If you're looking at it as a free cash flow basis, so over the 5 years, it's about $3 billion per year, which is 11% of the current free cash flow number, 2021. And if they grow free cash flows at 15%, which I think is probably conservative, it's just 6% of 2025's free cash flow. So that is really irrelevant because they just have the net cash position to donate, or whatever you want to call it. So really, I think it's insignificant at this point, and probably a good thing for kind of holding off the crackdowns and the regulations and everything else.
It's more like if this is it, then like, okay, we can live with this. But if it was something more severe, that I think that's a good way to put it.
Yeah, I think it's an asymmetric bet in that regard, and it should probably
such a weird way.
It should probably just be underwritten if you're looking to, analyze the company basically as higher taxes. That's kind of the way I think about it.
Yeah, that's how I think of it too. It's significant, but it's important not to overblow it, like Frank's saying. Though, I mean, if you think more of this is coming in the future, which could also be the case, you could just kind of increase that. You could look for a higher margin of safety, which is kind of the answer to everything. Just try to get a fatter margin, and then that'll solve everything except total insolvency and bankruptcy. So
the other thing that come up when I
good insight here from Karthik as well.
Oh yeah, go Tom.
I was just saying we got a good insight here from Karthik in the comments, but you go ahead, Frank.
So the other thing that come up on my thread with people commenting was all of these links to articles from Apple and Facebook and Google and their contributions they've made towards very similar causes like Jobs in America and things like that far outweigh $15 billion. I think Apple pledged something like $400 billion towards similar types of causes over a longer time period. So as a percentage basis, it's very similar to what Alibaba is doing. So it's not a thing that's just exclusive to China where these big corporations are kind of encouraged to do good for the community that they're operating in. Right. It's kind of just par for the course. Like big businesses, that's what they end up doing. It's part of helping their brand. Whether or not, I'm not even completely sold that this is 100% pressure from the Chinese government to force them to do this. It's kind of like they can do this. It helps their brand. It obviously pleases the government. So why not? It's just a cost that's probably worth it over the long term.
It's kind of like a lot of big tech firms censoring certain things. Like, the government's not mandating that they do it, but they kind of talk like they might. So they'd rather just like jump ahead of the ball, like get ahead of the, get ahead of the curve and just smother it now before it gets worse. And then that'll get the government off them for some time until some other issue comes up. When you're a huge business, all the attention gets on you, whether it's warranted or not. Par for the course is probably the best way to put it, like you said, Frank.
Was that Apple number right, Frank? Did you say 400 billion?
I'll look it up. It's over a long time period. It's on my thread.
Okay. Is it like 100 years?
Apple commits
50 years.
I've got the article opening right now. Apple commits 430 billion in US investments over the next 5 years, is what they've said. And a lot of it is through creating jobs through things like 5G technology and different engineering jobs. So there's going to be a return on that $430 billion. It's not, here you go have this, which could be, I would argue, the case for Alibaba as well.
I guess time will tell. That's all we could say. Thankfully, or whatever, it's not like the entire balance sheet. or something that's totally catastrophic yet. It seems unlikely that like that would happen, but it's always I guess there's always a risk of something fundamentally being just like a torpedo into a business from the government. And that's really in any country. Like you get significant regulatory risks. It's just understanding kind of like where they might come from and when, which you can never totally predict. But yeah, it's definitely whenever as the company gets bigger, all the negative and positive attention gets on it, and that brings with it a new set of risks. So it's so hard to grow a business past a certain point, partly for that reason.
The wording on the Alibaba thing too, so I'll just compare that to what Apple said. The 15 billion is an investment in science and technology to support small and medium-sized companies to enter the global market. It's to increase employment rates and help reduce inequality, which really doesn't sound like they're just going and handing out $15 and getting no return on that investment. I would argue there's going to be a significant return on that $15 billion. Just like Apple, when they're spending $400 billion, I'm sure they're going to get a significant return back from that. It's just a kind of corporate spin of doing good for the community. And I think that's partly what's happening here with Alibaba.
It could be. It's just an interesting way to, the spinning is what's so interesting, how it's being spun. And it's very unclear what exactly this is. And we'll probably never get a clear answer, I'd bet.
I think you sort of had to expect it after the 10-cent pledge as well. Yeah. I don't think it's completely unexpected. And just while I'm looking at it, that comment from, is it Ike, about seeing something venomous on my ceiling? I've got a second screen up above my laptop here, so if I'm ever looking up, I'm like Googling these numbers Frank's telling us just to do some fact checking. And all the venomous stuff's in Australia.
You're in the safe place in New Zealand.
Yeah.
Alrighty, we should wrap it up. We're at an hour 20. Love me a good long episode. So I guess almost all of our episodes seem to make it to this point now, which is great.
That was a fun one.
Because we always got a lot of good questions from you guys. So thank you for everyone who's active in the chat. And if you haven't already, be sure to subscribe so you don't miss next week's episode. And if we didn't get to your question now, maybe we get to it then. Maybe your question will change or you'll come up with another one and we'll do our best to get to them. And we should have, I think we'll have our full crew. We shall see. But hopefully. If you guys got value out of this video, however you want to value this show with an intrinsic value calculation, please, I hope it is enough to at least warrant a smashing of the like button. I'd very much appreciate that. That would help the channel out a lot and expose this to new people who want to learn more about value investing or just talk about all things stock investing and with that value sort of lens. And check out the Discord as well. I don't want to forget that. Otherwise, we will see everyone next week.